Hi everyone. Welcome back to the channel. Did you know that nearly half of all Social Security recipients are paying taxes on the benefits they spent decades working for? After years of paying taxes, working hard and saving money in a tough economy and being into the system, a retiree can face a tax bill on up to 85% of their Social Security benefits. So, you may be wondering, how did we get here? Could this soon change under Trump's new proposal to eliminate Social Security taxes? I am going to share details, context, and historical event points in this video. Let's discover and discuss the controversy, the history, and the impact of tax policy and Social Security, and what it could mean for your retirement. Before we jump into the schedule and dates, don't forget to hit that subscribe button and like this video so you never miss out on our latest videos. We put in a lot of time, energy, and effort in putting the information together so you can make informed decisions. Your support means the world to us, so please motivate us by clicking like and subscribe. The taxation of Social Security benefits began in 1984, and after that it has only seen one minor adjustment since then. Here's how it works. Single filers are taxed on up to 50% of their benefits with incomes between $25,000 and $34,000 a year, and up to 85% on incomes over $34,000 a year. For couple married filing jointly, they are taxed on up to 50% of their benefits with incomes between $32,000 and $44,000 a year, and up to 85% for incomes over $44,000 a year. It's too much of taxes while inflation is through the roof, uncertain economy, and dynamic economic outlook that changes very often. While your entire benefit is not subject to tax, up to 85% of your benefits could be. If you're looking at these income thresholds and thinking they seem low, it's because they were initially set back in 1983, with one adjustment made in 1993. Essentially, they were set 40 years ago. So yes, those numbers do look low by today's standards. It's important to note that these numbers are not indexed to inflation, so they haven't changed since that time. What would those numbers look like if they had been adjusted for inflation? Let's look at it more closely. Stay tuned and watch the full video, because it's going to be very insightful for you. If adjusted for inflation, single filers would be taxed on up to 50% of their benefits with incomes between $81,000 and $108,000 a year, and up to 85% for incomes over $108,000 a year. For married couples filing jointly, taxes on up to 50% of benefits would apply to incomes between $103,000 and $142,000 a year, and up to 85% for incomes exceeding $142,000 a year. It's no small thing that these income limits are not subject to inflationary adjustments. Now I hope that is clear for you. The House Budget Committee desires to more closely conform the income tax treatment of Social Security benefits and private pension benefits by increasing the maximum amount of Social Security benefits included in gross income for certain higher income beneficiaries. Reducing the exclusion for Social Security benefits for these beneficiaries will enhance both the horizontal and vertical equity of the individual income tax system by treating all income in a more similar manner. This aligns with the premise of the Social Security program, which is designed to more equitably distribute social funds. Initially, this tax only targeted high-income beneficiaries, ensuring those with significant income contributed back into the system. Over time, without having these numbers indexed to inflation, bracket creep has ensured that these taxes ended up being applied more broadly as incomes increased. Lawmakers may have underestimated how inflation would erode these thresholds, but it's more accurate to assume that the decision not to index these numbers to inflation was a deliberate political compromise. When this tax was first introduced in 1983, roughly 10% of Social Security recipients owed federal taxes on their benefits. Today, that number is about 50%. Why hasn't Congress adjusted these thresholds for inflation, especially when most other Social Security metrics are tied to it? For instance, FICA tax limits, Social Security payouts, and the bin points in the calculation are all indexed for inflation and adjust annually. Viewing this as an oversight is simplistic. Rather, it was likely designed to act as a stealth tax, gradually including more people over time. Now this is debatable, but let's discuss this in more depth. Should these benefits be taxed? This question sparks debate. There are many ways to address this. However, one argument suggests seniors shouldn't have to pay taxes on benefits since they've already paid taxes on earnings during their working years. Otherwise, this is akin to double taxation. For many seniors, Social Security is their only source of income, and taxing these benefits could worsen their financial situation. On the other hand, proponents argue that taxing Social Security benefits generates crucial revenue, especially with the program facing a projected shortfall by 2035. Eliminating these taxes would reduce revenues by $1.5 trillion over the next decade and could accelerate insolvency by 1 year. Let's talk about who's affected. Recipients are paying taxes on their Social Security benefits is something worth taking note of because that was not the original intent of a progressive taxation system. Rather, it is a consequence of these income thresholds not being indexed for inflation. Once you reach retirement earnings that are generally subject to ordinary income tax would be withdrawals from traditional retirement accounts, traditional earnings if you're still working, rental income, and of course, yes, Social Security income. For example instance, if we have a married couple who has a traditional 401k, and let's say they are required to take out a $50,000 distribution from this 401k. Let's also say that each individual receives $1,500 a month from Social Security, so total $3,000 between them both as a couple a year, with a total of $36,000 in income on an annual basis. All of a sudden, in this example their household has an annual income of $86,000 a year and 85% of their Social Security benefits would be subject to ordinary income tax. This could result in a hefty tax bill that this household didn't otherwise plan for. On the other hand, let's instead say we had a couple who funded a Roth 401k. If this couple did decide to take out $50,000 from that account to fund their retirement activities, there would be no income tax due on this distribution. So if their household income is $36,000 from Social Security, following the standard deduction, their income will not be subject to any tax at the federal level. This example also illustrates the importance of having different accounts to consider thoroughly when it comes to your retirement, so you have greater flexibility. The debate over taxing Social Security benefits isn't just about dollars and cents. It's about fairness, sustainability, and ensuring retirees can live with dignity. Some argue that taxing Social Security benefits creates an unfair burden for today's seniors. Others argue that it's a necessary piece to the puzzle to keep the Social Security program afloat. But what's clear is that this tax now affects more people than it was ever originally intended to. Because these numbers and these thresholds were introduced decades ago to address a different situation and never indexed for any inflation. The recent presidential campaign and the proposal to eliminate taxes on Social Security benefits have put these issues in the spotlight. Are we easing the burden of seniors, or are we accelerating the insolvency of the program? Well, of course these aren't easy questions at all, and they don't have simple answers, but they are certainly things that need to be addressed. I hope you found this video interesting enough to get you thinking about the situations that the seniors are in. What do you think? Share your thoughts in the comments below. If you found this video helpful, please don't forget to like, subscribe, or share. See you soon.